Hi everyone, thanks for joining. I think we'll get right to this. First up, we're going to have John Pusheen, co-founder and managing director of Pusheen Cook Capital. He brings 25 years of experience to the private equity investment experience to the industry, and he's held roles in operations, he has board of director experience, and he has a very successful track record for non-controlled investments. I'm going to go ahead and just let you get started, John, and if you want, you can do it up from the podium or you can sit, but whatever you're most comfortable with is fine. Okay, great.
So I will give a thumbnail sketch for Pusheen Cook. My partner Everett Cook and I have been in the sort of private equity business a long time. And what we really like is working with smaller companies. So when we talk about buzzwords, we're not from middle market, we're lower middle market. And we define lower middle market as companies generally under $200 million in revenues, north of $5 million EBITDA. And the sectors that we tend to really focus on are B2B, healthcare services, and consumer. Within those broad sectors, there are sectors we really like and sectors we don't like. But I think over 30 years, we've been working with these smaller companies and helping them grow in these sectors. And what we like about working with these smaller companies is when you work with a $50 million company, we feel we really can grow it to a $100 to $150 million company. When you work with $2 billion companies, it's hard to grow it to a $4 billion company over a 4, 5, 6, 7 year time frame. So we continue to focus on small companies. And by focusing on small companies, we really have to get sort of involved in operations ourselves in a way that's much more significant than if you're investing in larger companies that have professional management teams. So both Everett and I, and increasingly our junior partners, get involved in operations to help these companies grow. So that's the summary there. Focusing on Doe & Ingalls. Doe & Ingalls, company founded in 1986. They were basically a distributor of specialty chemicals that were mission critical, that would be used in chip factories, that would be used in biopharma businesses, where if that chemical wasn't there as a cleaning product, where it wasn't there as part of the chain of making the product, you could basically shut the business down. And so it was a mission critical distribution business that provided products that were sort of low in cost, but critical, and typically under 3 to 5 year contracts. So a nice steady business had been built up by the principals over a bunch of years. Hold on, move back a second. So what we found in due diligence was that there was a good basic business. The principals had become they got to the point where they were taking out $1 million, $2 million a year, and were risk averse. And so we thought there was an opportunity for this business to grow well in excess of the rate it had been growing. And that was the opportunity we were going to take advantage of. But in doing that, we needed to sort of firm up the management team, and we needed to firm up the systems and processes. They basically didn't have a CFO. They outsourced their CFO function to a CPA firm, and they didn't believe in marketing. They believed in sales, but not marketing, and not selling marketing to their customer base. So anyway, there was a bunch of opportunities that caused us to find this. We finally ended up doing it. The results, and I'll go into some more details in a minute, but basically we tripled the business. It keeps moving on its own.
It's automatic, sorry.
Oh, okay. It tripled the business organically. We opened regional centers in Maryland, in California, which are business centers that they hadn't been in. Originally it was just North Carolina, Florida. And then we did an acquisition of a sister company in Massachusetts. So all those things caused us to have a very attractive return on investment, but it's not without a lot of hard work. So if we just go through quickly what the challenge was, these two entrepreneurs were quirky. They didn't believe in sales and marketing and operations and finance and admin. They believed in sort of loosey-goosey concepts about how businesses are run according to them. And so the titles of what we had to have for every one of the companies seemed dysfunctional to an outsider, but the way they wanted to run it was fine. And ultimately, we explained to them that if you want to say that a CFO is cost analysis and business finance, we can call it that, but at the end of the day, we want that person to do a whole lot more than those functions. Upgrading systems, this is always a sort of long discussion we have with most of our entrepreneurs. Some of them are in QuickBooks. These guys had outsourced the function to a CPA firm. It's very important to have good information, particularly for these small companies, and so one of the first things we have to do is do these upgrades to the systems. You have to pick which software you can use. You have to make sure that you have the appropriate processes to use the software, and then once you figure out what your processes are and what the software is, then you have to figure out what modification you need to do to the software to make sure that you've got all the data that you need. This is time-consuming, so we do it with all our companies, but it's a critical way to establish a solid foundation on which to grow. The second piece is the people. Typically a lot of the entrepreneurs have either family members, or they have friends, or they have people in positions that are maybe not the best people in those positions. And so we typically take 6 months to 12 months to get those positions filled with very strong people that are going to allow the company to really start growing very quickly. And so that foundation is critical in terms of getting started with the companies. We had a quirky thing where there was one Virginia location where it had 30% of the EBITDA tied to one customer. Ultimately, that customer went into bankruptcy, and we ended up losing that business. We collected 100% of our receivables through that bankruptcy, and we had prepared all our financials, assuming that company was eventually going to go out of business, so we never went out of covenant the entire time we were investors. So you can plan for even when bad things happen. You can certainly plan for them and make sure you do what you need to do. We had a transition of CEOs. We had 3 CEOs over a 3.5-year period. It was all planned. And the way to make that work is to make sure that the CEOs are doing the same thing. They all have slightly different styles, but the business approach is exactly the same. And that is what allowed us to go through those transitions. Opening warehouse in new geographies. This, as you can imagine, these chemicals are all very dangerous. There's some that are explosive, there's some that can catch on fire, there's some that have to be in freezers. And so building these warehouses is quite complicated, but that causes us to have very little competition. But it really makes for expansion into new territories an expensive process you have to think a lot about and make sure that you have set up and built enough business from one of your customers who are large enough to have multi-regions, and then make sure that as you build that new warehouse that you will be able to immediately serve that customer base with the products that they like. Purchasing a sister company. The sister company was called Doe & Ingalls of Massachusetts, and the guys we invested in were originally spun out of the original company. 3 generations later, the guy running the business there are so scared of their shadow that we could never seemingly get a merger of these 2 companies or an acquisition done, because they felt as soon as they signed a deal, their grandfather, great-grandfather was going to turn in their grave and say, you sold out the business for too cheap. And so dealing with issues like that are always a huge challenge for us, but they're a real part of ultimately, when you do get things done, of helping build real accretive value. On an exit, I think the issue was we had been approached by other distribution businesses that also distribute chemicals, and there's, as you can imagine, a lot of those. But many of them knew our business really, really well and had approached us over the years about potentially buying us. And we talked and said, no, we shouldn't have any conversations with any potential trade buyers or any financial buyers until we're ready. And we got to the point where these calls started getting fairly regular, and the business got to the point where we thought maybe it's a good time to seek to sell it. And so what we did is we talked to about 10 potential buyers of the business and said, there's no investment banker involved, this is not for sale. We'll allow you to do some due diligence, explore and figure out whether you think where this business is going and where you're going makes sense to come together. If there are good business synergies from a revenue standpoint, not just costs, and you think that that's something that you would like to explore, then we can take the conversation one step further. So out of the 10 potential buyers, 3 of them came back after 3 months of nosing around a little bit and said, we really think there's significant synergy opportunities and we'd like to potentially look to buy the business. And we said, okay, why don't you give us a proposal of what it is? And ultimately the synergies were significant. And so we were able to sell the business at almost 12 times EBITDA. So I think that, you know, we did it without an investment banker being involved. We just managed that whole process ourselves, kept it quiet. We knew that we didn't need to hire an investment banker because the investment banker wasn't going to approach any new trade buyers. We talked to all the trade buyers, and bringing in financial buyers, nobody was going to bid 12 times. So we didn't have to bother hiring an investment banker. Quirky, a little quirky. All our deals are a little quirky, but this is one that I thought had enough quirkiness that the audience might be interested in. That's why it's cut. Thanks.
Thanks, Sean. Does anybody have any questions? I actually have a question, unless, okay. I have actually a few questions. You said that you went through 3 CEOs, and was that on, you said that that was actually planned, right? Why would you need to go through 3 CEOs?
Okay, so the 2 founders, one was CEO, one was COO. And then there was the head of sales and marketing, which was likely to be at some point in the future the CEO. But the first CEO wanted to step out after 2 or 3 years, and so he did that. He felt that this young guy, sales and marketing, wasn't quite ready for it.
I see.
So we ended up sort of brokering the COO taking over the CEO role for about a 1.5 to 2 year period until the young guy was able to get everything
I see. So they were
comfortable
all
that he was ready for the position.
in-house.
Yeah, all in-house.
Okay.
I have a quick question.
Yeah.
Sure.
You talk about dealing with the families and, you know, then there's the specialty chemical expertise. You know, can you quantify which is more important and, you know, how you are able to express experience in dealing with legacy businesses, families?
So we work a lot with family businesses. So for us, that part of it is easier to explain because we've done more of it. We've done a lot in the chemical business or chemical related businesses. But those businesses are all very specialized, so once you learn it, you sort of know it. But the harder issue, the more, you know, intangibles with personalities and fears and egos, and is all about people. And so the people issues are always far, far, far harder for us to deal with.
Okay, thank you, John. Thank you. Jeff, I'm going to ask you, I don't know if you want to stay sitting or you want to stand. Yeah. So we're bringing up Jeffrey Stevenson. He's a managing partner with Lawrence Schuler Stevenson, and has the overall responsibility of firm management and management of each of its funds. With that, I'm going to let Jeff take it over and tell you a little bit about his case study.
Okay, great, thank you.
Thank you.
We're a relatively small group, so if we can make it interactive, that would be great. So feel free to ask questions as we go along here. So just a quick background on us. So like John's firm, we have been in private equity now for 25 years and focus on the lower middle market. Our areas of specialization traditionally have been media. That's changed a lot over the years. So today, in fact, I think there's still a lot of overlap in terms of what we're doing. It's tech-enabled and data-enabled business services. We do a lot in information solutions, education, and increasingly healthcare, information technology. So we've had 6 funds to date, 4 buyout funds and 2 structured capital funds. I'm going to focus on talking about the structured capital funds today. So that represents about $3 billion of capital over that period. Most of what we do is in the U.S. We have also an office in London, and I'd say about 20% of our activity has been in Europe. So the structured capital business we launched in 2005, and the opportunity we saw at that point was really to do non-control investments. So with the buyout fund, we were primarily doing control deals, traditional change of control transactions, And the opportunity we saw was to provide financing to typically non-sponsored founder entrepreneur companies that are looking for growth capital. Because if you think about the world of private equity, most of it is populated by private equity firms in auction transactions, dealing in a competitive situation where they're buying businesses 100%. Mezzanine funds that are out there are chasing sponsors around. Banks are set up with sponsor coverage groups, et cetera, et cetera. But there's this whole universe of either family-owned companies, entrepreneur-owned companies that are looking for capital for growth, but don't necessarily want to sell control of the business. So that was the opportunity that we saw, and in that we were in the private equity business for so long and we're seeing a lot of deal flow, we were seeing deal flow of a non-control variety that we thought we could take advantage of. So that was really the genesis of the first fund in 2005. We've had two structured capital funds to date, the first being a little over 100 million, the second being a little over 300 million. And the idea is to be flexible in terms of how we structure deals and how we make the investments. And by that I mean it could be anything from senior debt to equity. Now, for the most part, the investments are structured as sub-debt with warrants and some purchased equity. So, give you a hypothetical, we'll make an investment of about 25 million. About 20 of that will go in the form of sub-debt that has a coupon, has warrants attached to it, and then about 5 million is in the form of purchased equity. The benefit to the company, to the entrepreneur, is it is much less dilutive. So if they take in growth capital, then by definition that will represent a much larger percentage of the equity. Whereas if we're structuring part of that capital as debt or as preferred, then it's going to be less dilutive in terms of the percentage of the equity, which ultimately is the most dear to the entrepreneur. And if the company is right, inevitably the company's projections are a lot more than our base case projections, then that'll end up being a much better structure for them, because ultimately the return, the percentage of the equity that they're giving up will have that they're retaining will have much greater yield to them. We'll still get a very good return, and everybody will win in that equation. So really the attraction, I think, is less dilution in terms of the equity. And then from our point of view, the attraction is that we're putting in most of the capital in a preferential form, again, usually sub-debt, sometimes preferred. So that's got protection in terms of the downside. A lot of times we get the question of, well, how do you deal with control issues versus non-control issues? And what I would say is that for the most part, it's really identical. From a covenant point of view, usually a private equity sponsor isn't stepping in and doing anything dramatic unless things are going wrong. So you usually will trip a covenant, you'll need additional capital, and that will bring you to the table to be able to effectuate whatever the change is, including changing out the CEO or making changes to the capital structure. So where we've had problem situations, we found that we're not in a different situation than if we were in a control position where we've got a majority of the equity. That is how we approach structured capital. So we're generally targeting about a 2 times return. About half of that is coming from the equity component, about half of that is coming from interest. And what's interesting is that these deals are structured as typically 5-year deals, with the first 3 years being a no-call period. If the company is doing well, then because it's expensive debt, they'll want to take that out and refinance it after the 3rd year, which we're fine with because we still have the equity position that rides until the 5th anniversary. So from our perspective, the capital is coming back sooner, so therefore the overall holding period has got a shorter duration, but the overall return, because of the equity component being meaningful, can still generate a 2 times plus return. So our average holding periods here have been more more like 4 years versus a typical holding period of 5 years, 6 years, or 7 years. You can see some of the components. So we feel that there's a lot of the attributes here. We're able to mix and match, and in a standard change of control transaction, there's, for the most part, one variable, which is the purchase price. Here, the value equation can be changed by a number of different factors. It could be the coupon that we have on the debt. It could be the warrants or the price of the warrants. It could be how much equity we're purchasing. So there are a lot more variables in the equation that we can deal with. So a couple of case studies. So this first one is a company called the Tax Credit Company. So this is a business service company, a lot of technology involved where they help businesses, particularly in terms of getting federal and state tax credits related to hiring. So it could be veterans, disabled people, it could be in low-income enterprise zones. So for example, Starbucks is a client, so Starbucks gets something like 1,700 applicants a day, and we sit behind that applicant system to tell Starbucks whether or not that candidate is eligible for a federal or state tax credit. So there's hundreds and hundreds of millions of dollars that's available out there in terms of federal and state tax credits. Because it's the government, it's a very Byzantine process in terms of figuring it all out. So this company basically provides the technology to help large employers sort through that and ultimately collect federal and state tax credits. So the case study here is that this is a business that was started by an entrepreneur. He had a number of original angel investors. They were approached unsolicited by a third party to buy the business. So naturally the investors were interested in an exit. The entrepreneur, who I think at the time was say 40 or 41, was not, but obviously had to be responsive to the situation. And so that resulted in a sale process. When we met the company, it was obvious to us that the entrepreneur was excited, was motivated, passionate about the business, and really the last thing he wanted to do was to sell. So what we said, well, but what we find is interesting is that so many of the intermediaries that are out there, they kind of only have one gear, which is it's a sale transaction. It doesn't get too much more complicated than that. So, but to I think the casual observer, I think what we observed was this really wasn't the right outcome for the company or for the entrepreneur. So we kind of said the obvious, which was, why don't we provide this capital? You can take out your investors, and you, the entrepreneur who currently owns, say, 40%, can increase your percentage because we're going to invest the $25 million it takes to take out your investors in the form of sub-debt. We'd like to get a 10% current pay coupon on that, and 24% in this case, penny warrants. So that was a win-win-win because the investors got cashed out. The entrepreneur increased his stake in the business. Obviously, he extended his, using a runway, so the buzzword, I guess we're not supposed to, he extended the life of the deal. And from our point of view, there's no senior debt above us. We're the only capital in the capital structure. The company is got a lot of cash flow, so we feel that we're very protected. We've got a current pay coupon, and obviously we've got these penny warrants, so we participate in the upside. So, it's just a different solution than you would typically have in a standardized exit where there's only kind of one outcome. So, the point really is that there's so many opportunities that are like that are out there besides just sort of a typical change in control transaction. And just quickly, this is a software business for hospitals. We're in about 1,000 hospitals. We also focus on healthcare information technology. It's focused on cost containment. We sell into the CFO suite. We integrate with financial, operational, and clinical systems. You'd be amazed at how many hospitals, or percentage of hospitals that are not profitable, so they got to focus on their costs. So this was, speaking of working with families and so forth, this was a husband and wife team that had been very, very successful in building the business. It was a very difficult thing for them to ultimately decide to have an exit. So we stepped in, and I think that the key to it in terms of getting the deal was to be able to speak for all the capital. So we actually financed all the debt and all the equity with the intention, no third-party capital, no third-party debt, with the intention of then refinancing out the debt portion of our position after 12 to 18 months. But it was very tricky because we had to get the founders comfortable that the transition would be handled appropriately, because this was their baby, this is the company they had started. And they didn't really want to exit themselves operationally right away, and nor did we. But to get the company to the next level, we had to bring in outside management. So that was part of the original plan. So I think we had a successful transition. We brought in someone from Allscripts to become the CEO. He worked well with the original founder team. The business is substantially larger now in terms of its revenue and EBITDA, grows at 30% per year and has for 5-6 years now. And we've actually been able to recapitalize and take out 100% of our capital, both the debt and the equity, with plain vanilla senior bank debt, relatively low cost, and we still basically own 100% of the business. So again, a different sort of way of addressing a potential opportunity, in this case more of a controlled transaction. But from our point of view, we're putting in the debt and the equity, so not a standard private equity type transaction.
Thanks, Jeff. That's a great story. Does anybody have any questions? I know we're a little over on time. I just want to. Okay. With that, Jeff, thank you so much.